Good morning and welcome to the Brazilian American Chamber of Commerce's 7th webinar series, seventh edition of the webinar series, COVID-19, What Lies Ahead? Brazil's Monetary Policy Response to the Pandemic. I am John Welch, Executive Director of the Brazilian American Chamber, and on behalf of the Chamber, we wish you all health and safety in this difficult time. COVID-19 has elicited an unprecedented monetary and credit policy response from the world's central banks. The Banco Central do Brasil is no exception, creating and implementing a plethora of vehicles to keep Brazilian financial markets liquid and helping the private sector access emergency credit. To talk about these aspects of Brazilian monetary policy, we have as our keynote speaker, Banco Central do Brasil Director Fabio Kanczuk, and our discussant from Opportunity Asset Management, Marcelo Fonseca, to discuss these policy initiatives and the market reaction. And our moderator is my colleague and friend, Paulo Viera, Cunha, who is partner at VERBANK Consulting and a director here at the Brazilian American Chamber. He is also a member of the advisory board of the Munk School of Global Affairs at University of Toronto and was head of macroeconomic research at ICE Canyon, also deputy director of the governor of the Banco Central do Brasil. And prior to that, for a decade, he produced and managed research for global securities banks and investment banks such as Lehman Brothers, HSBC. For nearly 15 years, Mr. Viera held managerial operational research positions at the World Bank, and he served in various capacities in the Brazilian government as a senior researcher at IPEA, at SEBRAP, and professor at the University of São Paulo and Rio de Janeiro. Mr. Viera holds a PhD from the University of California at Berkeley. Before turning the screen over to Paulo, I would ask you please to use the Q&A tab for questions. You can make them at any time and we'll look to answer them as we get into the discussion. Thank you very much. Paulo?
Good morning and thank you, John. This is a good time to have a talk about Brazil when the markets are rallying. The Tesouro Nacional just announced a new sovereign deal and the real is stronger than it has been in a month. But it is, for me, really a privilege to introduce Deputy Governor Fabio Kanczuk. You have his bio and know that he has had a distinguished career in academia, the market, and public policy. It is never enough to thank the Deputy Governor for what he did as a key part of the economic team that brought Brazil back from the brink in 2016, 2017. To his credit is not only the restoration of macro stability, with a remarkable turnaround in expectations, but also seminal contributions to major structural shifts, such as the elimination of interest rate subsidies and the implementation of the budget ceiling law, a linchpin for fiscal credibility. In his current role, the Deputy Governor has helped consolidate a new regime of monetary policy in Brazil, one with more durable inflation expectations and a lower structural level of interest rates, with continued deepening of the financial system and new forms of market competition. Perhaps more important today, the Deputy Governor is part of the team addressing the devastations of the crisis, a response that has changed the operational parameters for monetary policy, introducing an unequaled expansion in liquidity, potentially amounting to close to 19% of GDP, much needed new rules for the use of collateral by the central bank, and effective, but also potentially controversial changes in capital requirements, direct lending to the private sector, and a capacity to implement a form of QE through purchases of government bonds in the secondary market. At this moment, it is critical to hear what the Deputy Governor has to say. The evolution of the crisis is uncertain, and if one thing is clear, it is that it will last longer than first envisaged. Using the banking system as a conduit in moments of crisis is problematic, for naturally, risk aversion increases in proportion with the need to lend, no matter what the capacity is to lend. Direct lending to firms is something that has never been attempted And in any event, this measure, like several others, is partly delayed by political and implementation difficulties. The question is, will much of this Herculean effort arrive too late? Then there is the question of the costs, not only this year and the next, but in the longer run. Without fiscal support, will low interest rates provide the intended stimulus without threatening financial stability? We congratulate Deputy Governor Kanczuk for his contributions to public policy and for his unremitting dedication for the public good. It's an honor to have him address us today. Please, Fabio.
Thanks a lot, Paulo. Nice words. Thanks for having me. That is not unprecedented. That's something that is not unprecedented, but you gotta repeat unprecedented a few times in any presentation you do nowadays. So I'm being sure to make a few times. Let me talk before we get into Q&A and difficult questions that I'm sure Marcelo is gonna ask me about the next movements in monetary policy and also this discussion on QE and so on. Let me go through a little bit of how I saw, and I would say how the market saw the pandemic happening through all our meetings in the central bank, the Copom meetings, how they evolved and how we saw the shocks from the pandemic hitting Brazil. First time we mentioned the COVID was in February, mid-February, where we already knew that something was happening in China, right? In the province in China, so something big happening there, but it seemed kind of contained. And we also knew of some cases in northern Italy. But for some reason, the markets and we in the central bank didn't think it was going to hit Brazil. It seemed like an international shock only, not domestic. The reason for that was, okay, maybe the mortality is very low and discussions like that. And also a very common comment was, in China, they can do a lockdown and people would stay at home because of the system they have there. But this system would never be applicable to a Latin country or to Brazil. People wouldn't follow. People would keep going to streets and working. Nobody would care about it. So it was seen as almost a irrelevant crisis in February, and an international one. When I thought about the shocks that would hit Brazil, the first one to think about was some global supply chain shock. So we thought, okay, if China is under the COVID, maybe they're not going to have some products and some inputs of other products are not going to be available. Something similar to the Japanese earthquake, where some goods cannot be produced because you need a component of that is produced in somewhere different, and we cannot have it. But that type of shock is not relevant in the case of Brazil because we're such a closed economy, and because we're so far, unfortunately, to the global supply chains that we didn't think was relevant. The only thing that seemed relevant was some changes in commodity prices. So if China had a little crisis, commodity consumption from China would go down, commodities prices would go down. Also, we would have some BRL depreciation, and this would affect inflation, at least in the short term. And so from the Copom, from the central bank point of view, we said, okay, we have to look at the prices of commodities and the BRL depreciation and see the balance between these two and how this is going to affect inflation in the short term. And that's about it. It's monetary policy as usual, nothing big. This view changed completely in March. So March was a crazy month. And it changed totally the view of the crisis. So it became a domestic issue. We said, okay, this is gonna come. The size of it wasn't clear. We thought as a small thing in the beginning. Remember when the Fed lowered the rates by 50 basis points in the beginning of March, and then everyone would say, It's crazy. Why are they doing that? Do they know something we don't? And markets would criticize, saying they're just creating panic because there's nothing here. And Dr. Bernanke would say, this is at most a very short-term technical recession, no big deal. And we thought of it in Brazil markets and also the central bank as something that would last maybe a month or two and would hit part of the economy, something similar to the truck driver strike that happened before that hurt part of the economy for some short period of time. So it wasn't supposed to be big. And the numbers also, they were not big. I remember in the week of the Copom, markets were thinking that GDP growth in Brazil, rather than growing plus 2.3 or 2.5, would grow maybe 1.6. But so it was a hit of maybe 1 point of GDP, but wow, not so crazy. But things were changing very, very quickly. In that week of the Copom, we saw growth in our calculations moving from +2 to 1.8, and then 1.6, and then 1%. And then we start to consider a stress scenario where growth was going to be 0. I remember presenting the inflation report a week after the Copom decision and say, we thought about growth equal to 0, but it was so outdated. So the numbers everyone knew was much lower. But during the Copom meeting, we are still questioning how relevant the crisis was, how big it was. I remember one of the members of the Copom came wearing a mask in that meeting, and we made fun of him. Why is this schmuck wearing a mask? They don't need to do that. But I would say, even though we thought it was a small thing, 1% of GDP, 2% of GDP, on qualitative terms, it changed completely our view. So rather than international was domestic. And then the types of shocks that we had to worry about were very different. First shock was a labor supply shock. So people are not going to be able to work. And so production is going to go down. In academic papers, started to think about that and say, okay, maybe if you have a labor supply shock in a sector, it's going to create a demand, negative demand shock in other sectors, and started to work on that. But I would say this type of thought was not really relevant for the central bank and the markets. For central bank and the markets, they started to see something much bigger than this labor supply shock. Something in Brazil we call the álcool gel shock. So people would go and buy all the alcohol gel in the drugstores, and then other people wouldn't have alcohol gel for them. In the US was more like a toilet paper shock, right? So maybe the Fed was thinking about toilet paper. So wow, there's no toilet paper. And this shock can be seen in economics as two different phenomena. One of them, fear, people scared about their future stream of income, and by having this perception, reducing a lot consumption of other goods, buying only alcohol gel and toilet paper, but scared. So a big increasing in precautionary savings, big decrease in consumption. Same thing happening with firms saying, wow, this is gonna hurt us. So I have to produce less and not even think about investment now. So big negative shock in demand. And something else, a liquidity shock. So no toilet paper, no alcohol gel for everyone. As big firms would go to banks and use pre-approved lines to get cash. They say, well, I'm gonna get all the cash that I need because I'm gonna have to pay people and pay my bills during a month or two, and I'm not gonna have any revenue, so I need cash. And cash disappeared. Central bank had to act, and did act very quickly, and I would say very boldly, in this direction of providing liquidity. So we reduced a lot reserve requirements. We made a waiver in provisions of capital if banks renegotiated debt. We put in place that payroll program where firms would borrow money at very cheap rates with some risk sharing by the Treasury, and this money would go straight for payroll so that firms wouldn't think about the cash for the payroll. All these measures that amount to these very large numbers of GDP, and they were all related to liquidity. Liquidity is a business of the central bank. And then, if I may, I should say there's this difference that we always keep in mind in our discussions, the difference between solvency and liquidity. So the question as we saw it is, for a few months, firms are not gonna have cash, and that's a liquidity, but firms are still good business after the crisis. So when you look at the net present value of the firms, even though they're gonna have costs for a few months and no revenues, all the future flow of profits are more than enough to justify the firms to remain open and profitable. And I don't wanna destroy this organizational capital of the firms. So since the central bank is the only provider of liquidity, it's the only agent that can print money, can provide liquidity for as long as it needed, and tends to make money on that if that's the issue. So the central bank should go and provide as much liquidity as possible through the financial sector, and from there it would go to the firms. And also these other measures to go straight to the firms, like the payroll program. Also another one that worked pretty well was this subordinated credit program, the Letra Financeira Garantida, where we would do refinance in this type of credit. So big chunk in liquidity, that was our focus. And in terms of monetary policy, since the size of the crisis was still thought to be small, the monetary policy stimulus was small. So what we wrote in our communication in March was something, look, I look at some calculations and I need more than 50 basis points of stimulus. But I'm a little bit worried about the fiscal developments. It was also very early to know what was going to happen to the fiscal developments, but we started to get worried about it. So if fiscal gets worse, I have to take that into account when I do monetary policy. And then I'm gonna only lower by 50 basis points. So that was kind of our view in March. Then it comes May. In May, another meeting, and I would say from the qualitative point of view, no changes. We're still thinking about the same shocks. See that the shocks changed a lot. So it began as global supply chain, then it was commodity prices, then it was BRL depreciation, then it was labor supply shock, then was the toilet paper, that is a liquidity plus low demand. But now the size of the shocks, wow, now it's big. Then when we thought about growth, we and the markets, rather than thinking about 0 plus 1 growth, start to think about -2, -3, -5% growth. When we look at capital outflows in Brazil, capital flight, biggest ever, 10 times bigger than in previous crises. And that made us worried. So why is it so special about this crisis that it's hurting so much in terms of capital flight? And we made some reflections in our communication, like, okay, different from the global financial crisis, the epicenter of the crisis moves. It's not going to stay only in the US and China and Europe. It's going to come here. So this is a reason to hit emerging markets more than proportional than in crises that happen only in developed countries. Other issues, it's going to hit more if the country has a limited fiscal space. And then unfortunately, Brazil is in this case doesn't have a lot of fiscal space. We knew that the epicenter would come to Brazil. And so, okay, makes sense that it's going to be hurt. And we have to think about it and move in the best way we can, considering these constraints. In terms of monetary policy, our communication, well, now the thing is big. The output gap due to this negative demand shock for the increase in precautionary saving, the fear, means that we need to have a lot of stimulus. However, the fiscal developments are bad. It means that the government is going to spend a lot more money that we thought of, and it should spend, but we have to take that into account in the monetary policy. So it was common to see gross debt forecasts by the market saying, oh, rather than having gross debt at maybe 75% of GDP, it's going to go up to 90, 95% of GDP. So it's a big changing numbers. And as we saw it, this would change the neutral rate because it means a chance of having fiscal problems in the future. And by changing the neutral rate, it changes the place from where monetary policy provides stimulus. The way we motivated was, okay, maybe 3 years ago in 1915, 16, Brazil would have a neutral rate of maybe 6% or even higher, the discussions in the market. And because of the expenditure ceiling, social security reform, and the change in the TLP in the credit markets and so on, we start to think of neutral rates in Brazil lower than 3%. But now, because of the crisis, there's a question if Brazil is going to continue in the same path of lower and lower neutral rates, or it's going to go backwards and have an increase in neutral rates. And by doing so, we have to think of the right Selic rate in a new neutral rate, even though we were very optimistic about it and say, okay, the ceiling is intact, and that means that at some point that's going to go down. It doesn't really matter what I think. I need to know how markets are going to digest this big increase in debt, and we have to take that into account. And then we will end up making a decision to reduce 75 basis points and signal to at most another 75 basis points in the next meeting. And this was connected also with some discussions on an effective lower bound for rates that I'm sure we can talk about soon. So that was May. Same qualitative, but a big change in size. How do I think things are going to evolve in the future? Are they going to have different shocks? Should we think about it in the same framework? Hard to say as usual. But I would say there are some discussions like what Paulo mentioned, saying this crisis is going to last longer. And everyone is changing their minds in this direction. If it lasts longer, the liquidity issue of firms can become a solvency issue. So even though firms look okay, it's hard to have a firm that can stay for 1 year without revenues and still be profitable. Other related issue, how is going to be consumption behavior in terms of sectorial consumption during this crisis and after? Are people going to go back to movie theaters? Are they going to change their behavior? Maybe the firms that would be profitable later are different from the firms that were profitable before. How do I know which firms should live and which firms should die? I don't know. We're not equipped to know that in government, in the central bank. So how should I go about it? Something else. Even though liquidity is pretty much a central bank business, solvency is not. Solvency is fiscal, and by so it's a treasury business. So things should have a support by Treasury, like the Fed that is going and doing the main financing facility with the support by the Treasury. So this type of questions come, and how the government is going to support, and how the government is going to choose the firms that should survive and not only waste the money in firms that should die because of different consumption pattern. I maybe see things moving this direction. They're pretty hard, and we have to think about it. But again, a little bit less central banking and a little bit more Ministry of Finance. I should stop here, and let's go for some discussions of anything you guys want. Thanks so much.
Thank you very much, Fabio. This was truly excellent. Again, congratulations on all that you have done, and it's really admirable to have someone of your intellectual capacity in the position you're in at this particular time. I mean, we clearly need it. Marcelo, do you have some questions?
Yes.
Please.
First of all, thank you, Paulo, for inviting me for this panel. Thank you, Fabio, for your remarks. You've given a thorough description about the monetary policy strategy during this evolving nature of the COVID crisis. Yes, as you mentioned, this is a crisis which natures changes over time, and therefore your approach in terms of monetary policy have been adapting to these changes. And then I would like to explore what comes next in terms of monetary policy. Since the last couple meeting, a lot of things in global markets in Brazil have changed. We've seen a very aggressive rebound in asset prices, risk asset prices across the globe. That acute pressure of dollar funding that you referred to in your remarks seem to have receded a lot, to the point that even emerging market currencies have posted very sharp appreciation in the last few weeks. In the last few days in Brazil, that's have been the case with the BRL gaining a lot of ground on the back of the terrible losses of the past couple of months. Domestically, you raised the issue. I think it's everyone's concerns, the fiscal concern. It's not an issue that will be resolved or made clear in the short term. However, in the past few weeks, we have taken some, I would say, positive signs from Congress and government in the form, for example, of the approval of the package, of the fiscal package to help the finances of states, which in the end ended up to be better in a better, much better format than initially presented. So my point is, having said that, and considering that the central bank is, let's say, learning by doing along the process, I wonder whether the original message that you've conveyed in the last meeting still holds. It seems, for example, like that the Governor Campos recently have acknowledged that the crisis, although grimmer, is perhaps less certain. So to me, it looks like he is recognizing that things might have changed since the last couple meeting. I'd like you to address that issue, if you could.
Sure, thanks, Marcelo. So, like you mentioned, big changes in asset prices since the last couple meetings. Big improvement in the long part of the curve and in the BRL. We saw that in part as markets realizing things were not so bad, but I wouldn't say that it changed the way we look at things and the framework we have. We still have to go and balance these two large effects. One of them, big drop in demand, increase in precautionary savings. That means an increase, very large increase in output gap, and that asks for a lower Selic rate. And on the other hand, increase in fiscal risk, meaning higher risk neutral, and that calls for an increase in Selic rate. And you have to take the difference between these two large numbers and try to find the right or the optimal monetary policy. And that's the framework, and we still have the same framework, and we just have to think and update these numbers and the way we think about it. And what I should add is that when you compare the prices now with the prices before, one thing that gets confusing is that we already had some expectations that things would get a little bit better. So I would say it's not obvious that things were better than what we expected at that time. Let me just move. I'm very sorry. There's a lot of noise here. And in this sense, it's not obvious that I would say that the communication is outdated, or the decisions and everything that we mentioned are not the same anymore. I guess that's as much as I can say.
Yes, thank you. Thank you very much for that answer. Marcelo, do you have another question that you would like to address?
Yes, my second question is somewhat related to the first one, and it involves this, I would say, very controversial issue about the limits of monetary policy in emerging markets. This is a subject that has become very controversial in Brazil. You guys, I think, were the first ones to bring to the public this discussion when you made public, and by the way, congrats by the transparency, when you made public the divergent views within the committee about the effects of further rate cuts. There are some people within the committee that believe that from a certain point, that might be more harmful than positive for the objectives of monetary policy. There are also people with a different view that believes that Brazil needs to take care not only of the quote-unquote domestic equilibrium, like in a conventional inflation target framework, but also to the external equilibrium. And if not, were to deviate from the inflation target framework, the central bank should incorporate that dimension, and which, by the way, has to do with the currency. And again, since the last meeting, the currency has become a much less of a problem for the central bank, for the inflation objective. So I would like to hear your views, at least from a conceptual point of view, about this discussion, where you think the right approach would be.
All right. So this effective lower bound may be not the best name, because it suggests that after you cross the bound, you cross that limit, something very different would happen after that, right? So when you have a limit, you think that after that, some qualitative things are going to be different, like the effect of some policy would change direction, or maybe some assets going to disappear, and you're going to have an equilibrium with very different characteristics. I wouldn't think that's the way that I'm thinking about the effective lower bound. I believe that even if you lower rates below this bound, you would still have that lower Selic rate would implying higher inflation. And part of it would be through the exchange rate channel. So the issue here that the central bank is worried about has more to do not with inflation, but with financial stability and how very big depreciations can hurt growth, and in special firms that don't have a perfect hedge. So I'm talking about a balance sheet effect and how depreciation might hurt those firms. There are other effects that we can talk about, like the issue of higher prices of capital goods that I don't find empirical support, but it's commonly mentioned. And also just the behavior of entrepreneurs of associating big depreciations with a problem and retracting their demand for investment because of it. So the issue that we had in mind, the central bank had in mind, I go and make the calculation that I pointed out in the previous question. I'm sorry about the mess and the noise. I say, okay, I look at output gap, the increase, and I look at the increase in risk neutral, and I found by that the optimal stimulus was something like at most 150 basis points or less than that. That's the signal that we gave. So at most 150 basis points to address the question of output gap versus risk neutral. But I'm not gonna move in only one step because I'm worried about the big movements in the exchange rate due to the lowering of the Selic rate, in the sense that I'm less worried about this, this collateral effect of the exchange rate, then I can worry less about that and worry more about the game between output gap versus risk neutral. And this was the sense that I was trying to convey in the previous answer, say, it's not clear that things moved in a direction that I have to change my way of thinking and change the optimal monetary policy. It's true, the markets became calmer, but that has to do with that secondary issue of financial stability. It doesn't have to do with the primary issue of meeting my inflation target that has to do with output gap and risk neutral, not the instability of the financial sector per se. Going a little bit back to your question, say, do we have to change our framework to put in this international equilibrium constraint? I would say we don't. So this international equilibrium constraint is just the movement in the exchange rate. The movement in the exchange rate goes through inflation as usual. Like I mentioned, it's there, it's the pass-through, we think about it, nothing new about it. It's just that when markets are very unstable and when we're looking that the elasticity of the exchange rate to the interest rate seems very large, order of magnitude larger than what we would expect by uncovered parity condition, you say, I have to be careful there. I have not to think only about my inflation objective, but also think about financial stability. That is also a mandate of the central bank. So I don't have to change my framework, but I have to think of the stability of the financial sector and of firms as a possible constraint for moving too quick.
Thank you, Fabio, and thank you very much, Marcelo, for your questions. And these were excellent questions and even better answers. John, I think we have a few questions online that perhaps you could ask them.
We have a couple, and we'll probably get some more. The first, we have two that are related. They're really talking about R star, the equilibrium real interest rate, the Wixelian one, The first part of this, considering the recent market rally in CDS, BRL, local rates, is it a fair assumption that the BCB assessment of the effective lower bound for the Selic is lower than 2.25, as indicated in a recent official communication? And the other question is, what are your general thoughts about the equilibrium Wixelian rate?
Yeah, so I would say I didn't see as this 225 as something that it was written in stone and something fixed that we have to have in mind and we cannot cross. We saw different members from the committee making different calculations, some of them using more the CDS, some using the coupon rate, the dollar rate in Brazil, and some playing with different duration of these different assets, some looking at the long part of the curve in BRL and extracting a premium from there, some looking at what would be the scenario for debt over GDP and saying, oh, CDS market is not very liquid and sometimes takes too long to really realize what the problem is. And I have to look at debt over GDP evolution to really think of what's gonna happen to the risk neutral rate. So something that people don't have a clear number, people disagree, and it's a dynamic number too as you change your views. So it's not clear, like the question asks, that because CDS goes down, you think, no, it's not 225, because 225 wasn't really a very clear number. The 225 on my mind was more related to the optimal monetary policy, thinking about the output gap and risk neutral, not as a limit to do monetary policy because of the effective lower bound. I would say that these two concepts are kind of getting confused. So one thing is the risk neutral rate, that I have to put the risk. I have to maybe use CDS and use other stuff to think of what is the optimal monetary policy. And the other thing is the effective lower bound. That is a level after which I'm afraid of moving quickly, because that might mean that markets are going to react very abruptly, and the depreciation will be so large that it would hurt growth and the financial stability system.
There was a corollary about that question about our star. The question is, you had a rather substantial increase in debt, and we'll probably get a lot more on the public sector side. Not quite clear yet what the private sector is doing, of course, because they've been part of that capital fight was paying down external debt. What do you think? I mean, certainly an increase in private sector that would probably lower our star, whereas the public sector increase would probably raise it. Do you have any thoughts of the trajectory of public debt at this point?
I would say markets, market expectations is pretty good about what would happen to government debt, and talk to most people, they're thinking about debt over GDP reaching numbers higher than 90% this year, and then at some point going down in the future. And I think this is the big issue to think about our star, much more than the private debt.
Okay. We have a question about the labor market. The labor market reacted extremely fast to the pandemic. For a labor market that is fairly rigid, was it surprising to you and the board? And how fast do you think the labor market can recover when recovery comes?
I would say labor market is reacting pretty much as we expected. It's delayed compared to growth. And what we think it's going to be different this time is the elasticity of employment to GDP or to unemployment to GDP. So like an Ocon law. In the US, it's typical to have numbers like 1/3, like 1% of GDP means 0.3% in unemployment. In Brazil, it's a little bit higher, but we think this crisis, because of the nature of the crisis that is related in a way to that story of a labor supply, that this Ocon parameter is going to be bigger, meaning the increase in unemployment or decrease in employment is going to be bigger than what is expected given a certain GDP shock. But it should recover later. So I'm starting to pick up some worriness about that, some hysteresis, but I don't see this as a big concern. I think it's always lagging, but it should go back to the previous numbers after the crisis is over.
I think Marcelo has a question. Marcelo?
Yes, I'd like for Fabio to explore a little bit about what the central bank has in mind in terms of the framework of the asset purchases. Everyone knows that this constitutional amendment approved last month would give you a full authority to implement purchases of public and private debt securities. There's still pending legislation that will give more details in the program. But in terms of the framework, some people has been referring to this program to the Brazilian version of the Operation Twist. I have some differences with this expression, because in the case of the US Operation Twist, there was a very clear intent to compress the term premium of the assets purchased by the Fed, and therefore by that to promote a portfolio kind of twist from safe to risky assets. Could you clarify to us the similarities and the differences between the two programs?
Sure. So it's pretty much like you said. So in the US, they reached the lower bound. They couldn't do any more monetary policy. And then they do a twist or QE for monetary policy. So their idea was to compress the long part of the curve rates. We think of that a long part of the curve as being composed by two components. One of them, the expectation of future short-term rates, and the other, the term premium. And Bernanke would say, no, I'm gonna go and buy out those long-term bonds, and I'm gonna make both the expectation of future rates to go down and the term premium to go down. And by doing so, I'm gonna provide stimulus to the economy. I'm gonna do monetary policy. Brazil, very, very different from that. We are not in the lower bound. As we talk about in the previous questions, there's this discussion of the effective lower bound that has to do with financial stability, and meaning that you have to go slow, you have to be careful, you have to move carefully not to hurt economic agents and firms. But we are pretty far from the from the zero lower bound, and we can continue doing monetary policy as usual, using the short-term rate, the Selic rate. And by doing so, the PEC, the thing that the permission from the Congress to go and buy long-term bonds, treasury bonds, has to do with the functioning of the market. Is completely analogous to the exchange rate intervention. So when we look at the long part of the curve and say, okay, in addition to the expectation of future rates, in addition to the term premium, and in addition to the risk premium that Brazil has and the US doesn't, right, related to fiscal risk, there's something else there that is a bad functioning of the market. The prices are crazy, maybe because of liquidity, and the market's not able to digest this big chunk of new bonds that the treasury has to put in there. Then the central bank goes and acts, but very carefully, not to distort the other parts of the rate. just to make markets function, like in the exchange rate interventions. The name twist tends to be associated with monetary policy, and that's not what we have in mind. But in a way, it is twist, because when you go and the markets are not functioning and you go and buy long-term bonds, you are shortening the duration of bonds. So it is twist, but the objective is very different.
Thank you, Fabio. This is a critical point, and I like to return to it. John, I think we have a question from Samir about fiscal policy, and I'd like to follow up on that question related to this question of the intervention in the treasury market.
Okay. Question is, how confident are you that the fiscal policy response to the crisis and higher spending in 2020 will reverse next year? Are you concerned that the spending ceiling could be broached again next year as well, reached next year?
But my impression, I'm being very optimistic about that. I don't see anything that is risking next year ceiling or budget. It looks to me that everything is gonna go back to normal next year. When I talk to our friends in the Treasury, that's what they tell me. They know a lot more than I do, and they say, oh, we're gonna prepare next year budget fulfilling the expenditure ceiling, and everything looks okay. So I would say very optimistic about it. But in the central bank job, I would say it doesn't matter so much how I see it, but how markets are gonna digest it. And I have to pay attention to that when I think about monetary policy.
Yes, thank you, Fabio. I mean, I think that's a critical issue, isn't it? I mean, we know that in the past, the Central Bank of Brazil was the last resort for the rollover of the debt. If you think of the 2002 crisis and also the crisis in 1999, early 2000, there were points where the central bank rolled over practically the entire stock of that on the overnight. And so the question comes as to what are kind of the signals that you can look if you're going to be using the central bank to directly intervene in the secondary market. What kind of signals of stress would you be looking at to determine whether you are really facing more of a transitory shock of liquidity, or whether, you know, for one reason or another, you may be facing a deeper problem of lack of confidence in the fiscal authority?
Thanks. I would say it is analogous to the exchange rate. In the exchange rate, we're never sure if there is a bad functioning of the market or not, but we do the best at every point in time. So we look at what happened to the peers. We look if there was some bad news that is only related to Brazil that justified to move away from the peers. And then we try to intervene in the exchange rates to correct if there is this bad function. We also talk to dealers and see if there's some liquidity issues that are a big flow that day, or what is moving, and some more anecdotal information. And that should be the same in the long part of the treasury bills. We look at there and say, okay, this is moving today too much. I look at the peers, they are okay. There's no news here. And today there was some big problem in liquidity because this flow happened, so I need to go there and do it. Or it's okay, it's business as usual. So it's very analogous to the exchange rate. I would say it tends to be easier to intervene without making mistakes in the treasuries than in the exchange rate. The exchange rate is always so volatile that it's sometimes you don't know what's going on. Things move and you say, I don't understand if it's a problem of bad functioning of the market or it's just because things are so volatile. Interest rates, even the long part of the curve, is less volatile. So it's easier to spot when something crazy is happening, something related to the bad functioning of the market.
Thank you. Thank you very much, Fabio.
Well, we have
Marcelo, I don't know. Do you have another question? We are running
Yes,
out
I have one.
So this will be the last question, and a quick one, please.
A quick one, yes, sure. I'd like to go back to that 2.25, let's call it telegraphed terminal level, right? Let's call it that way for the lack of a better word. And you made it very clear that this level doesn't have anything to do with any concept of effective lower bound, but rather it is the result from a central bank which is still holding to the inflation targeting framework, and therefore came up to that number in terms of what is the most appropriate or optimum level of interest rates when we look from the inflation targeting regime framework, right? Having said that, this number is derived or was derived based on previous assumptions about a number of variables, including, for example, the level of forecasted level of inflation, and mainly the level of the economic degree of economic contraction, activity contraction that we are about to see in the Brazilian economy, among other things. Since then, I think not only markets, but also maybe the central bank have been updating their views about the size of the death of the depression, and it's going to be much worse than we thought up to a month ago, right? Having said that, it's natural to think that if this number is the result of the process of the inflation targeting framework, it should be perhaps updated by this new reality about the degree of the economic damage, right? Am I jumping too quick to the conclusion, or just to say that this level is also part of an evolving framework, and as time goes by and we find out that the contraction is worse than originally thought, we might be thinking that we could stretch further these limits of monetary policy. That's my point. That's my question. How am I wrong in this conclusion?
I would say in terms of framework, it's perfect. So next meeting we go again, we see if there is a financial stability issue, and as you mentioned, markets are calmer, and the exchange rate issue becomes a little bit less of a concern. One thing that is important, the committee, as we put in, before saying anything, the committee doesn't everyone think exactly in the same way, and I'm trying to be transparent about it. So you see there's some different thoughts. I'm putting out my thoughts, okay?
Sure. Sure.
So as you mentioned, exchange rate less volatile and markets calmer, and you have to worry a little bit less about the financial stability issue. And then you have to worry more about the balance between output gap and risk neutral rates and the fiscal. And from the previous meeting to now, gotta go and think and see numbers and everything. But I think it's fair to say that growth seems to be smaller, right? A bigger depression than before. On the other hand, the fiscal expansion also seems bigger than the one we had before. And you see how markets are changing its debt over GDP forecasts, that it's been increasing a lot. So this forces neutral rates up. And again, you have to go and balance these things. And also
you're saying that not only growth has changed since then, but other elements that affect the trade-off, let's call it, of the central bank has also maybe moved in another direction.
Right. Then you have oil, right? Oil prices went up, and then you have currency appreciated, and then you have inflation expectations came down. So it's all these pieces that you have to try to put together, play with models, play with thoughts, and see what is optimal.
Right. Got it. Thank you so much.
Fabio, we have a couple more questions. Two related to foreign exchange. First, what is the present international reserve management strategy? Second, the central bank has realized a very big capital gain on their foreign exchange reserves. What is the status of perhaps a transfer to the Treasury of some of that capital gain? And what's your opinion about that?
Starting from the last part, I think it's fair that the central bank transfer part of the profit to the Treasury. You just have to be careful not to have a chance of hurting the future financial situation of the central bank. So you have to choose the right amount so that the central bank is not at risk in the future. But things are evolving okay, right? So I'm not up to date to the discussion, but it's happening between Minister Paulo and the President Roberto Campos, and they're going to come into something, but don't see such a big deal. Things should be okay in there. On the reserve management, our view is that the amount of reserves that Brazil has is okay, is within the limits that make sense in terms of the right amount of reserves. And then I mentioned all the benefits that reserves bring to us in a crisis. Not that you have to sell those reserves, because they're acting with the portfolio effect, that they value a lot more, and that reduces net debt. So this is happening, and markets are reacting to that. So the problems are not as big as they could, because when you're hit, BRL depreciates and your reserves are have a higher value, and net debt goes down. So that's the most important part of the reserves, and they're acting okay. So there's no goal in terms of reducing or increasing the amount of reserves. We are acting just to improve the functioning of the exchange rate markets. But when you do so with small amounts, right? So those amounts are not big enough to make you worry about the level of reserves, the fraction of GDP. They're just small amounts here and there to make markets work. And now, since markets were stressed, we were selling a little bit. And maybe in the future, markets are going to be excessively optimistic. We're going to buy a little bit. And this wouldn't affect big time the level of reserves of the fraction of GDP.
Thank you. Thank you very much, Fabio. This has been an extraordinarily candid and very, very useful discussion of the plumbing of monetary policy and of the outlook for the near future. And it has helped us all, I'm sure, understand much better how monetary policy is working in Brazil and how you're managing this difficult time. I'd like to ask you now if you have any final comments before handing the meeting back over to John for closing it.
No, I'm okay. I just want to thank you so much for the chance, and I'll be hoping we meet again soon to do another one like this.
Oh, very good. Thank you very much, Fabio. Thank you, Marcelo and Paulo. Thank you, Paulo, for moderating. It's been an honor and a pleasure hearing you all today. And thank you all for joining. I just wanted to remind you that our next webinar will take place tomorrow, Thursday, June 4th, for a discussion on reopening with Richard Jantz of Cushman & Wakefield and Andrew Bishop of Signum Global Advisors. Thank you all for attending again. Stay healthy and in good spirits. Take care.
Thank you.